Everyone's watching the stock market hit new highs, but something feels off, doesn't it? Valuations are stretched, the economy's slowing, yet the S&P keeps rising. Take this in. The S&P 500 is trading at a PE ratio of 28, above historical norms. And the Buffett indicator? It's hovering over 200%. That's nearly double the long-term average. The last time it got this high, we were heading into the dot-com crash. Now here's where it gets interesting. Warren Buffett, the man who's made billions by ignoring the noise and following the numbers, he's sitting on $350 billion in cash. That's not a typo. It's the most Berkshire Hathaway has ever held, and he's not deploying it. Meanwhile, Donald Trump is pushing through what he's calling a big, beautiful bill, a wave of fiscal stimulus. He's threatening tariffs again, pressuring the Fed, and talking up the market like it's the new American miracle. Now, what if this isn't just a bubble, but a planned bubble? What if this is intentional, part of a strategy to inflate, shake, and reset the game? Today, I am breaking down the 4 key factors fueling this market and how they connect directly to Trump's comeback strategy. We'll bring Buffett's signals into the light, explain what's happening in plain English, and most importantly, show what you can actually do about it. Because if this bubble pops, or is made to pop, the people who understand it early won't be the ones who lose. All right, let's start with the first factor, pure valuation math, or what Warren Buffett calls probably the best single measure of where valuations stand at any given moment. It's known as the Buffett indicator, and it's actually pretty easy to understand. Think of it like this. If you want to know how expensive the stock market is, you compare its total value, all publicly traded US companies, to what the entire country is actually producing each year, known as the GDP. So when the ratio is 100%, that means the stock market and the economy are in balance. But when that ratio starts pushing well above 100%, it means investors are paying a huge premium for stocks, way beyond what the economy is delivering. Right now, that ratio is sitting over 200%. That's not just high, that's historic. Back in 2000, right before the dot-com crash, it peaked around 160%. In late 2021, right before the market corrected and tech stocks collapsed, it was roughly the same. And now, we're far beyond that. Buffett has always been skeptical of markets that price in perfection. He's said many times, when valuations stretch this far, investors are ignoring risks and chasing stories, not fundamentals. To put it in relatable terms, it's like walking into a store, seeing a $10 item priced at $30 and still thinking it's a bargain because everyone else is buying it. Eventually, that kind of thinking breaks. Buffett once said, "The market is a voting machine in the short term, but a weighing machine in the long term." That's his way of saying hype can win the day, but over time, reality always settles in. And right now, the market's not just optimistic, it's borderline delusional. Earnings are softening, consumer spending is slowing, credit is tightening, and yet prices just keep floating up. Now here's where Buffett's real signal comes in. He's holding on to $348 billion in cash. That's not normal, not even close. Buffett's whole career has been built on buying great businesses when they're cheap, not sitting on the sidelines. So why all this cash now? Because he doesn't like what he's seeing, not just in prices, but in the entire setup behind those prices. He knows how fragile inflated markets can be, and how fast they can fall when confidence cracks. That's why he's not buying aggressively. He's waiting, watching, letting the system stretch. Because when it breaks, and he believes it will, he'll be the one buying, not bailing. And here's the connection to this video's bigger idea. Bubbles don't expand without help. Something, or someone, usually fuels them. And right now, there's a very strong case that Trump's economic playbook is doing exactly that. So let's look at the second factor, and this one has fingerprints all over it, Trump's economic strategy, or as he now calls it, the big beautiful bill. The pitch sounds familiar. More jobs, more growth, more American greatness. But the policy? It's heavy fiscal stimulus, revived tariff threats, and lots of pressure on the Fed. And all of that together? It's like pouring gasoline on a market that's already overheated. Let's break it down. After the 2024 election, Trump wasted no time rolling out a stimulus bill that dwarfed previous spending. Infrastructure, tax credits, defense increases, and even cash rebates for families. It's a flood of government money. That much cash racing into the economy pushes up demand. That demand fuels corporate earnings. And rising earnings? They push up stock prices. But here's the problem. The growth isn't organic. It's inflated. Think of it like a balloon. It looks bigger, but only because it's full of hot air. And eventually, that air has to go somewhere. Buffett doesn't talk politics, but he's made it clear what he thinks about debt-fueled market highs. He's warned that stimulus without long-term productivity is like eating dessert before dinner. It feels good now, but leaves you worse off later. His approach has always been about durability over dopamine. Then there are tariffs. Trump has restarted the trade war playbook, targeting Canada, China, Mexico, and even the European Union. He argues it's about protecting American workers. But history tells a different story. Remember the Smoot-Hawley Tariff Act of 1930? That one move turned a recession into the Great Depression. Countries retaliated, trade froze, and U.S. exports collapsed. Sound familiar? Buffett is deeply aware of that history. He's called tariffs a kind of economic warfare, something that backfires far more often than it succeeds. He noted that if you disrupt supply chains and create retaliation cycles, businesses can't plan, and markets start to wobble. Here's how that plays out. You tax imports, and prices rise for everyone. Consumers pay more, companies adjust forecasts down, and when partners retaliate, U.S. exports get squeezed, hitting earnings from the outside in. And instability? Markets loathe it. Now fast forward to today. Supply chains are still fragile from the pandemic and global economic uncertainty. Inflation is cooling, but it's not gone. And into that fragile mix, Trump is tossing tariff grenades. Companies are already warning of higher costs and softer margins. And yet, somehow, the market keeps climbing. Why? Because stimulus hides the pain. When you pump in enough money, even weak earnings can look good. It's like putting makeup on a bruise. Doesn't make it go away, just harder to see. Buffett? He's not buying the makeover. He's sitting on cash. Because here's the truth. When fiscal sugar rushes and tariff risks combine, markets can move up fast, but they can also fall apart just as quickly. It's like driving 100 mph on a spare tire. You can keep going, but it won't end well. And maybe, just maybe, that's by design. What if these moves aren't just economic missteps, but part of a calculated effort to trigger the next domino? Because if the market does start to wobble, if earnings disappoint, inflation returns, or debt spikes, the next lever Trump can pull is even bigger. It's not the market, it's the Fed. And that leads us directly to factor 3, the theory that this bubble may be about more than inflation or headlines. It might be about forcing monetary power, aka breaking the Fed, the interest rate leverage theory. This one doesn't show up in charts, it shows up in behavior. Because what if the market bubble we're watching isn't just growing on its own, but being engineered to break? Let's walk through the theory. Trump wants lower interest rates, badly. Why? Because low rates are rocket fuel for the economy. They make mortgages cheaper, borrowing easier, and stocks more attractive. Real estate booms, business loans multiply, and government debt gets easier to manage. In short, it's an economic cheat code, and Trump knows it. Back in his first term, he publicly attacked Fed Chair Jerome Powell, called him an enemy at one point for raising rates. He wanted zero rates, maybe even negative ones, anything to juice the markets and lower the debt burden. Now it's 2025. Powell is still at the helm. Rates are around 4.5%, kept high to battle inflation. But if growth falters, or the market stumbles, or job numbers sag, the Fed will feel pressure to pivot. That's the play. You don't have to ask the Fed to act, you just create the right conditions and let them feel the heat. So how do you engineer that pressure? You stoke uncertainty. You rattle markets with trade threats. You overspend. You tighten financial conditions just enough to make things feel wobbly. And when the headlines turn negative, you blame the Fed and force their hand. It's a risky move, but it's not a fantasy. We've seen it work. In March 2020, during the COVID crash, the Fed slashed rates to near zero within weeks. Markets snapped back violently. Tech boomed. Crypto went vertical. Real estate took off. Cheap money flooded every corner of the economy. Trump knows that playbook, and some believe he's trying to recreate it. Not with a virus, but with volatility. Now, let's bring Buffett into the picture. Warren Buffett has always been wary of ultra-low interest rates. He once called them the most powerful force in finance, like turning off financial gravity. Suddenly everything floats, prices soar, risks get ignored, and it feels like nothing can go wrong until something does. That's why Buffett doesn't bet during mania. He waits for dislocations, moments when everyone's running one way and value hides in the other direction. Right now, he's sitting on $348 billion in cash. Not because he's scared, but because he's patient. That cash is his dry powder. And he only fires when markets are irrational on the downside, not the upside. Because when the Fed cuts rates, and if Trump creates the conditions for them to do it, there will be another round of market frenzy, another sugar rush, another flood of hot money. And Buffett, he won't chase it. He'll be waiting for it to crash again. So what we're seeing might not be an accident. This bubble could be a setup, a way for Trump to force the Fed's hand, take credit for the rebound, and unlock economic conditions that benefit him politically and financially. But if you think that's the end of the plan, think again. Because there's one more factor that ties all of this together, and it's the most calculated move of all. Let's look at factor 4, where chaos isn't the side effect, it's the strategy. The strategic chaos, Trump's wild card. Now, Trump has always thrived in disruption. The more unpredictable the environment, the more leverage he seems to get. And this isn't speculation, it's strategy. Whether it's threatening to pull out of NATO, imposing surprise tariffs, clashing with the Fed, or starting trade feuds mid-negotiation, unpredictability gives him negotiating power. It keeps allies and enemies alike off balance. And in markets, that kind of chaos shakes the foundation. Look at what's happening globally. Ukraine and Russia are still in active conflict. China continues to flex on Taiwan. The Middle East is bubbling again with rising friction between Iran and Israel. These aren't isolated flashpoints, they're systemic risks. And when the US sends mixed signals on global leadership, those risks multiply quickly. Trump's comments about NATO, suggesting the US won't protect countries that don't pay their share, aren't just political soundbites. They introduce real doubt. If America steps back, other powers step in. That shift creates instability, and markets hate instability more than bad news. Buffett knows this. He's not a fan of chaos. He's said countless times that uncertainty is the enemy of investment. He likes rules, predictability, and systems that function without sudden pivots or erratic moves. That's why he tends to avoid emerging markets with political risk. That's why he favors businesses that perform regardless of election cycles. And that's why global instability doesn't excite him. It worries him deeply, but he's no pacifist. During periods of tension, Berkshire Hathaway has held positions in defense companies like General Dynamics and Raytheon, not because Buffett wants war, but because he understands how markets reprice during global instability and fear. He bets on what people will always need: safety, logistics, communication, infrastructure. And when uncertainty spikes, demand for those things skyrockets, often quietly but powerfully. Trump's chaos play isn't just about foreign policy either. It gives him cover to do more at home. He can push for emergency powers, fast-track executive actions, sidestep institutions, and reframe criticism as obstruction. The worse things look, the easier it is to say, only can fix this. It's a page straight from the strongman playbook. And it works. Now for investors, the key insight is this. The more uncertainty Trump creates, intentionally or not, the more fragile the market becomes. And fragile markets may climb, but they can't handle shocks. Buffett sees this, and unlike most, he's not chasing the climb. He's sitting back, waiting, watching. Because when the market finally realizes that uncertainty is the plan, not the byproduct, that's when things really start to crack. So here's the question on everyone's mind right now. If this bubble is being inflated, and possibly even timed to pop, what can you actually do? Start with defense. Before you chase any investments or try to beat the crash, build a real financial base. Buffett doesn't make moves until he knows the foundation is solid. That starts with an emergency fund. 3 to 6 months of expenses, in cash, where you can reach it. That's your safety net if the job market gets shaky or the economy slows down. Once that's in place, shift to smart offense, and that doesn't mean guessing when the market will crash. Buffett never tries to catch the exact top or bottom. He buys good companies when they're undervalued and holds them for years. You can do the same. Start with dollar cost averaging, investing small, consistent amounts no matter what the market's doing. It keeps you calm when everyone else is panicking. Diversify too, not just across stocks but across sectors. Add some bonds. Consider short-term treasuries, dividend-paying blue chips, maybe even defensive ETFs. These help protect when volatility spikes. If you're comfortable with risk, add a small slice of gold, crypto, or foreign currency for extra resilience. The goal here isn't to outsmart the market, it's to stay in position long enough to outlast it. Because when the bubble pops, and it will, the real opportunities don't go to the fastest traders. They go to the most prepared. If this bubble really is planned, if it's being inflated for a purpose, then knowing what comes next is a necessity, and now you know. Want to know what super investors like Warren Buffett, Bill Ackman, Michael Burry, Howard Marks, and Monish Pabrai are buying in this uncertain environment? Click the video on screen to find out.